Hello, everyone. This is Chapter 8. We are going to be completing the accounting cycle for our service business this week. So, before we go forward, let's take a look back at what you've already done with our accounting cycle. So, we started off analyzing business transactions. That was when we took a look at the source document and determined if it was a business transaction or not. Then we journalized it in our multi column journal. Remember that the journal is called the Book of Original Entry. It's the first place that there's written evidence that a transaction actually occurred. And to get in the journal, you have to have a source document. From there, we posted to the general ledger. Our general ledger shows all of the accounts with their balances. That way you can quickly and easily look up an accounts receivable customer and find out how much they owe us or how much we owe a company in our accounts payables. Whatever, it kept track of our balances. From there, we took the general ledger and we started working on a worksheet. We used the worksheet to do a trial balance to show that our general ledger was having debit credit equality. And we also used the worksheet to work out our financial statements. And this was just our rough draft. We took that rough draft before we did that, I should say, we journalized and we posted the adjusting entries that you worked out on the worksheet and updated the general ledger. From there, we used this worksheet to prepare our financial statements. We did an income statement and a balance sheet, and we prepared these in financial accounting format for other people to read and interpret, whereas the worksheet is more of an internal rough draft type document. Today, we are going to be talking about journalizing and posting closing entries. Closing entries are the second to the last step of the accounting cycle. The last step is to prepare a post-closing trial balance. So we're just about there. If I was in the classroom, this is where I would shoot off the confetti, poppers. We're at the end of our accounting cycle for our service business. So let's get started. I'm going to be walking you through a problem that I've created. We're not going to jump right into the work together. First, you really need to get a thorough grip and background about what has happened and what changes we need to make. Okay, so let me minimize this one. I should have another PowerPoint. Okay. All right, so 8-1 is recording closing entries. Step one, before we do anything else, is we need to identify the difference between a permanent account, which is also called a real account, and a temporary account, which can also be referred to as a nominal account. So let's start with the permanent accounts. Permanent accounts, this is the characteristics, and then I'm going to take us through a worksheet, a trial balance that I've already created, and we'll figure out logically which ones are permanent. These accounts would be used to accumulate information from one fiscal period to the next. In other words, those are permanent. My way of explaining it to you would be when the fiscal period ends, would it make sense for that balance to transfer to the next fiscal period? If the answer is yes, it's permanent. So let me bring you up to a worksheet that I've already created. I'm going to use this one as the example. Okay, so let's take a look at cash. Cash has a $4,900 balance. At the end of a fiscal period, should that account remain the same? In other words, this is December 31st, 2021. Would it make sense for me to start January 1 with $4,900 of cash? Of course it does. Cash is a permanent account. When you finish one year, you start the next year with the same amount of cash, correct? That's going to be very different than my temporary accounts. Cash is permanent. If I leave off one year with $4,900, I start the next. Same thing with petty cash. I'm not just going to get rid of my petty cash simply because the year has ended. Accounts receivable, that's permanent. David Banner owes me $500 as of December 31st, 2021. When January 1st happens, this is a permanent account. I'm not going to just get rid of his accounts receivable simply because the fiscal period ended. It's permanent. Same thing with supplies. This is a permanent account. We're going to start the new year with $600 of supplies. I'm not going to just throw them out and start over. All of your assets are permanent accounts. Next, we have an accounts payable. This is an amount that I owe to Davis Company. This is a permanent account. When the year ends, I'm still going to owe Davis Company $2,000 come January 1st, 2021. They're not just going to wipe away my debt simply because the fiscal period ended. This balance goes forward to the next year. I wish that were the case. Otherwise, we'd all be running down to retail stores, buying things on account, knowing that, oh, they're going to close out the account. Absolutely not. It's permanent. Assets are permanent. Liabilities are permanent. Then I have my K Young Capital account. It shows $3,500 on this trial balance. This is also a permanent account. The owner's capital account is going to be talked more about today in just a few moments. The owner's capital account is their financial claims against the assets. So according to this trial balance, I have a $35 claim against these assets. My creditor has a $2,000 claim against my assets. This is a permanent account. I'm not just going to get rid of I'm not just going to lose all of my claims against my assets just because the fiscal year ended. It would make sense for this account to be permanent and to transfer from one year to the next. I'll start the new year off with my capital balance. This is actually going to change though. So assets, liabilities, and capital are permanent accounts. All right. The opposite of a permanent account is a temporary account. There are certain accounts that we use to accumulate information until it's transferred to the owner's capital account. You might remember these are called temporary accounts. You hopefully remember back in chapter 1 and 2, remember how we used to use the capital account for everything? We would use the capital account to increase for a revenue, to increase for an investment. We would decrease it for expenses and drawings. Then I said, we're not going to do that anymore. We're going to set up separate accounts. But at the end of the accounting cycle, the owner's capital account will be increased for investments and revenues and will be decreased for drawings and expenses. Temporary accounts get closed at the end of a fiscal period and their balances transferred to a permanent home of capital. They're accounts that it wouldn't make sense to keep accumulating year after year because it wouldn't provide meaningful information. So let's take a look back at my worksheet. Okay, so these were all up to here. These are all permanent. These are permanent accounts. Once you hit drawing, everything from drawing down is temporary. And let's talk about why. So my K Young drawing has a $100 balance. That's going to be closed. And when I say close, it means reduced to zero. We're going to close that out and make a big subtraction to capital for $100. You wouldn't want to keep accumulating the balances of your drawing for 10 or 15 years. It wouldn't provide meaningful information. Income summary you're going to learn about in just a few moments. It's a temporary owner's equity account. It does not appear on the worksheet. You'll get to see what it does shortly. Next, we have sales. Sales for the month ended provides me meaningful information. I can tell on my income statement right here that I made $1,800 in sales in December. This is going to be for the month of December. This is going to be closed out. That way I can track my next month's sales. It wouldn't make sense for this account to keep on building up and keep on accumulating. What if you're in business for 25 or 50 years? You wouldn't have meaningful information. So this is going to get closed out, reduced to zero. The balance is it's not going to be just, thrown away. It's going to be put into the owner's capital account. Same thing with your expenses. I like to know what my monthly expenses are for supplies, rent, and utilities. I wouldn't want to keep this account accumulating and accumulating for year after year after year, because this is going to get into the millions. So accounts like drawing, sales, expenses, revenues and expenses are temporary in nature. We let their accounts build up, and then we close them out, transfer them, and start accumulating all over again. And you're going to see me going through this process. Okay, so let's get started. First, I'm going to show you the rules. These are the 4 closing entries that you're going to have to commit to memory. We'll have a lot of repetition, so it's nothing to worry about. It will become second nature. When we do a test or an assignment, they don't spell them out for you. The directions will simply say, prepare the closing entry, prepare the necessary closing entries. You have to know what to close and how to close them, okay? So before we get into closing, I want to back us up and take a look at what we have done so far. First, I'm showing you, and this is an abbreviated general ledger. I'm not showing cash. I'm not showing any of my, accounts receivables or payables. I'm just showing the accounts in my general ledger that are affected by closing entries. So let's take a look at what I have here. I have all my expenses with their balances in them. These are T accounts, but they're also the same thing as a general ledger. I have my revenue account and my drawing account, capital and income summary, which we're going to learn about. So I didn't put the plus and minus signs in. I am going to do that right now. Okay, that looks better. So I have the increase, decrease side showing for all of my expenses, the normal balance side of credit, normal balance side of drawing, and the normal balance side of capital. So this is what my general ledger looks like. I've already prepared my worksheet, as you saw, where I only had one adjusting entry, where I updated my supplies, and I'm showing all my expenses. And I already did my financial statements, because that's where we are in the accounting equation. Here is our problem. So I did my income statement. I prepared a statement of owner's equity where I changed capital to $4,000. Remember that we took the beginning capital plus the net income less the drawing. Capital is $4,000. So I changed on my balance sheet. My capital on my balance. Oh my gosh, this should say balance sheet. The capital on my balance sheet is $4,000. I have a huge discrepancy here. What I mean by that is my financial statements show capital to be $4,000, but my books or my general ledger still shows the old amount called $3,500. That is not acceptable. You cannot have a financial statement saying one thing and your general ledger saying something else. There's discrepancy there. And we can't just go in here and make the change to $4,000. We have to prepare a series of closing entries that will transfer the money into the permanent home of capital. Think about it as us creating like a paper trail, okay? So let's go to the rules and get started. The goal is going to be to make all of these temporary accounts closed, transfer the balances, and they'll end up in its permanent home of capital. So closing entry number 1 says, close revenue to income summary. Let's do that first. I'm going to be analyzing in T accounts before I journalize. So it says close revenue to income summary. Here's my revenue account. It's sitting here with an $1,800 credit balance. The only way to close, that means reduce to zero, would be to do the opposite to it. So to close revenue, I'm going to debit sales for $1,800. Once I do that, the balance would be 0. Okay? Sales is now closed. This $1,800 right now is nowhere. We need to put it somewhere. This is our new account. It's called Income Summary. A couple key points about it. I've already mentioned it's a temporary owner equity account. It's used for closing. I think about it, my best way of explaining this to you, it's a holding and a clearing account. Its normal balance varies. It doesn't have a typical memorizable normal balance. There are rules. The normal balance of Income Summary will depend. So I'll put this down here. If we had a net income, Income Summary would hold a normal credit balance. If we have a net loss, Income Summary would have a normal debit balance. And that should kind of, these concepts here should kind of make sense. Net income is positive, credit balance like a revenue, like capital, net loss, debit balance, like expenses, like drawing. Now, when you're doing your closing entries, this is not like, ooh, I don't know the answer. We already know twice. Here, I proved I have a $600 net income. And here, I proved I have a $600 net income. So it's not like you don't know going into closing entries. So Income Summary, I like to think about it this way. It has an expense side and a revenue side. Because I have a net income, the plus right here, it's the plus sign is going to go on the revenue side, and the expense would be the decrease side. If it was a net loss, the increase would be here and the decrease would be there. We're going to do a net loss together. Don't even think about that just yet. We're just doing a net income scenario today. Okay, so it says close revenue to Income Summary. Let's go back to my general ledgers. I have just closed revenue. This $1,800 is nowhere right now. I'm going to put it into this account called Income Summary. That's going to be my credit, $1,800. Income Summary is holding on to this money, and eventually it will get cleared into capital. Okay, so your first journal entry is a debit to sales and a credit to Income Summary. So I'm going to journalize this one. It's December 31st. My first journal entry would be, I forget the value that I used. It was a debit for $1,800. Oops. For $1,800. And it was a credit to Income Summary for $800. $1,800. Okay. All right. So for me, I was always taught, and when I'm doing this, I always dent slightly. You don't have to do that, but I just have to. All right. So there's my first closing entry. It's a debit to sales and a credit to Income Summary. This is the journal entry. If I were to post, this is how it looks. I'm doing it backwards, I realize, but that's the only way to explain this. This is how it looks in my general ledger. Okay? First closing entry, done. Let's go to my second one. It says close expenses to Income Summary. Okay, let's do it. I have to close each of these expenses out individually. So to close supplies expense, I would credit supplies expense. This balance would be reduced to 0. I would do the same thing with rent expense. This balance would be 0. And I would credit utilities expense. This balance would also be 0. I have credited 3 expense accounts. I am going to make what's called a compound entry. What I don't want to see you do, and you won't be able to do it on MindTap because there wouldn't be enough room, is you're not going to go 900, 200, 100. You're going to determine the total amount of all of the expenses and make a compound entry. Okay, so when you add up my 3 credits, we're going to make 1 debit to income summary because it says close expenses to income summary for $1,200. Okay, let's journalize that one. So it's a compound entry. It's 1 debit to income summary for $1,200. And I have supplies expense for $900, rent 2, and utilities 100. Okay, let's journalize it. Got to put a new date, even though it's happening on December. I just gonna put the date on there. So my debit is going to be the income summary, and that's for $1,200. And I have to credit each supplies expense, them all separately. Supplies expense would be credited for $900. Rent expense would be credited for $200. And utilities expense is credited for $100. Every time you make a journal entry, make sure you have debit credit equality. I have $1,200 of debits and I have $1,200 of credits. Okay, so let's go back to my general ledger. Oh, deal with the dog. Okay, so income summary now has a balance. The normal balance, because there was a net income, we've determined the normal balance of this account is credit. So we have an $1,800 credit and a $1,200 debit. The balance of this account is $600. Now, this number should seem kind of familiar to you. You're like, wait a minute, I think I've seen this before. Where have you seen this before? Twice. You've seen it before here, where I had $1,800 worth of revenues and $1,200 worth of expenses on your worksheet. You've seen it on your income statement, $1,800 of expenses, $1,800 of revenues, $1,200 of expenses. So really what this number is, I'll put a note here, this is the net income. Income summary has been holding this money, and now we're going to clear it into capital in our next step. Okay, so income summary is holding. The next step it's going to do is it's going to clear into capital. Okay, so we've journalized our first 2 closing entries. Now we're going to do the third one. The third closing entry says close income summary. Remember that income summary is a temporary owner's equity account. It only exists to hold on to funds so that they can be held and cleared into the permanent home called capital. Okay, so we need to close income summary to capital. When you look at my what I have going on here, there's a $600 net income. Balance, which is also the net income. So to close this account out, if it has a $600 credit balance, I'm going to debit income summary for $600, which is the net income, which would make income summary back down to 0. It's now closed out and we won't use it again until we do closing entries next fiscal period. Okay, it just temporarily held that money. So I just debited income summary. The balance is 0. If I make a debit, I must make a credit. Where do I close it to? Capital. So I'm going to debit income summary and I'm going to credit capital for $600. This is us giving me my net income. So this $600 is the result of revenues minus expenses. So this is what I cleared after I earned my sales and paid all those expenses. That's my net income. So let's journalize this transaction together. It's going to be in my journal on the 31st. Oops, I keep doing that. It's going to be a debit to income summary, $600, and a credit, okay, Young Capital, $600. So my capital account is increasing by $600. The story doesn't end here though. There's one last, so I'm not going to come up with a new balance because there's one last thing I have to do. I have to close drawing. So my last closing entry says close drawing to capital. I'm going to go back to my general ledger. I'm going to find my drawing account, which is right here. The only way to close it is to credit drawing for $100. This would make this account closed out, zero, ready to start tracking all over again. If I made a credit to drawing, I need to make a debit to capital. So this $100 here, this is my withdrawals. Okay? So my capital account increased by the net income and it decreased by the capital. My new capital balance on the books is now $4,000. Add up your credits, subtract your debits. I have a $4,000 credit capital balance. And that's important because look at my financial statements. I'm showing $4,000 on my balance sheet, $4,000 on my owner equity statement. Now this is showing $4,000. So they're all aligning and working together. Everything is good. So let's journalize that last closing entry of me closing out drawing to capital. Go into your journal like this. It's going to be a debit to K Young Capital. That was for $100. And it's a debit to K Young Drawing for $100. These are my journal entries. And this is how the general ledger would look once. So the journal entries have been posted to this general ledger. All of my expenses are closed. They're reduced to zero. They're ready to start tracking next fiscal period's rent expenses and utilities expense. My revenue account is closed. I'm ready to track next month's sales. So they're closed, but what happened is not forgotten. The balances have been, they were held in income summary and the results transferred to the permanent home of capital. The best analogy I can give you about this is it's very much like with your grades here at Londonderry High School. In my class, you got a grade quarter one. That grade at the end of quarter one got reported and it's being held in your permanent place called your GPA, right? So when you started quarter two, my grade book was blank. That doesn't mean what you did or did not do quarter one didn't happen. It just means that I'm starting to track your grades all over again. So when quarter two closes, I posted your grades. Their permanent home is on Aspen in your permanent GPA. But when I started quarter three, the grade book is blank and you start fresh again. The results of what you did in previous quarters don't go away, but it wouldn't make sense for me as your teacher. Think about like a math class for your math grade to be accumulating, keeping track of that same grade freshman year, one grade book for freshman year, sophomore year, junior year. Okay. Everything that you did is held in your GPA. Teachers start off every quarter. We close out your grades and start a new quarter, start tracking your grades all over again. So those are the 4 closing entries. One thing I want to point out, when we were doing financial statements, sometimes it has you doing this owner equity statement and sometimes it doesn't. If you were in a situation where it said, just prepare an income statement and a balance sheet, just remember that you don't need to prepare a statement of owner's equity. All you would do to calculate this capital is take the beginning capital, add the net income, and subtract the drawing. You should be preparing owner equity statements, but sometimes our book doesn't have you. Sometimes the problems just have you do an income statement and have you do a balance sheet. So if you don't have one, you can just recalculate capital on your own. The last thing that I want to bring up is when you're preparing, I'm going to bring up my other red X, when you're doing your closing entries, and you will be preparing closing entries from a worksheet, I want you to keep, you won't have the general ledgers like I just did. I want you to keep in mind this. Doing your closing entries, the trial balance and the adjustments are no longer relevant. When you're doing your closing entries, when you're closing out sales and expenses, you want to get it from the income statement and balance sheet columns. Remember that supplies expense has changed because we adjusted it. If I peek behind the X, it happens to be the same, but it's usually not. It's not going to be the same number. Usually our supplies expense is sitting at 0, okay? So make sure that you don't even look at trial balance and adjustment. When you prepare closing entries, you're going to look only at these amounts right here, okay? So that concludes this tutorial. We will be doing Work Together 6-1 next. Stay tuned. I hope this helps.